For weeks, whispers have haunted Wall Street's marble corridors. Whispers of bad loans, of fragile banks, of another storm forming just beyond the horizon. And now, those whispers are turning into alarms. What started as quiet concern among traders has spiraled into full-blown fear, sending shockwaves through the markets. The question on everyone's mind, is Wall Street sleepwalking into another financial meltdown? Wall Street's growing anxiety over bad loans isn't just about numbers. It's about trust. Beneath the surface of record stock highs and optimistic forecasts lies a silent crisis that's beginning to rot the core of America's financial system. For months, analysts have been warning that rising interest rates, tightening credit conditions, and slowing economic growth were creating the perfect storm for loan defaults. Now, that storm is here. Reports from several major banks show a sharp uptick in delinquent commercial loans, particularly in real estate and small business sectors. Office towers once bustling with life are sitting half empty, mortgage-backed securities are losing value, and banks are quietly increasing their reserves for potential losses. It's a haunting echo of 2008, but with a 2025 twist. Unlike the subprime crisis, this time the danger is scattered across multiple sectors. The Federal Reserve's aggressive rate hikes to tame inflation have pushed borrowing costs to the highest levels in decades. That means businesses that survived the pandemic are now struggling to service their debt, households are defaulting on car loans and credit cards, and regional banks are once again on edge. According to recent data from the Federal Deposit Insurance Corporation, the FDIC, non-performing loans have risen by more than 35% in the last quarter alone, a red flag Wall Street can't ignore. But the panic really began when one major financial institution, a mid-tier lender with significant exposure to commercial real estate, announced a multi-billion-dollar write-down. That single event triggered a domino effect, sparking sell-offs in regional bank stocks and sending fear rippling through the bond market. Traders began dumping risky assets, hedge funds rushed to short financials, and suddenly, phrases like liquidity crisis and credit contagion started trending on trading floors again. The irony? The same markets celebrating record highs just weeks ago are now questioning their own foundations. As fear spreads, Wall Street finds itself trapped between two narratives, the official optimism from policymakers and the grim reality of unpaid loans piling up behind closed doors. The Treasury Department insists the system is sound, pointing to strong capital ratios and higher cash buffers. But many investors aren't buying it. They've seen this movie before, reassurance right before the collapse. What's making things worse is the uncertainty surrounding how deep this rot goes. With hundreds of billions tied up in risky commercial property loans and interest rates showing no signs of dropping soon, the risk isn't just about a few bad loans, it's about the entire credit system freezing. And as history has shown, when banks stop trusting each other, the whole machine grinds to a halt. The interbank lending markets, the arteries of global finance, depend on confidence. Once that's gone, even a small tremor can bring giants to their knees. That's why investors are watching the next Federal Reserve meeting with almost religious intensity. Everyone wants to know, will Jerome Powell blink? Will the Fed cut rates to save the banks, or stay the course and risk a wave of defaults? But here's where things get more complicated and dangerous. The problem isn't just financial, it's psychological. Markets are built on emotion as much as logic, and right now, fear is spreading faster than facts. Hedge funds are moving cash offshore, major corporations are hoarding liquidity, and everyday Americans are starting to pull back on spending. The ripple effect could choke growth, push unemployment higher, and drag the economy into a recession even without a full-scale banking collapse. It's the kind of slow-motion crisis that creeps in quietly, the kind that policymakers can't fix with a single bailout or rate cut. Behind the scenes, some of the biggest names in finance, from JP Morgan to Goldman Sachs, are quietly preparing for the worst. Internal memos leaked this week suggest that contingency plans are being reviewed, stress tests are being updated, and liquidity backstops are being reinforced. The concern isn't just that one or two banks might fail, but that panic could spread system-wide before regulators can contain it. And while Washington debates fiscal priorities, Wall Street is fighting to maintain confidence in a system built on leverage and belief. What makes this moment uniquely dangerous is that there's no clear villain. In 2008, we had subprime mortgages and reckless bankers. Today, the enemy is more abstract. It's the accumulation of small cracks. Unpaid car loans, empty office spaces, delayed credit payments, and small banks stretched too thin. Each one insignificant on its own, but together forming a chain reaction that could pull the rug out from under the US economy. And yet, amidst the fear, there's opportunity. Veteran investors know that every crisis resets the game. Fortunes are lost, but even bigger ones are made. As bad loans mount and stock prices dip, private equity giants are already circling distressed assets, ready to buy cheap and sell high once the panic fades. The market has always thrived on one law: greed follows fear. The question is, who will survive long enough to take advantage of it? Wall Street is on edge, and the world is watching. Because if this bad loan crisis spreads beyond the US, if European and Asian markets catch the same fever, we could be staring down a new global financial storm. And this time, there might not be a bailout big enough to stop it. So what do you think? Are we witnessing just another market scare or the first tremors of a full-blown financial earthquake? Let us know your thoughts below. And if you want to stay ahead of the storm, where finance meets reality, make sure to like, share, and subscribe for more in-depth analysis of how today's headlines are shaping tomorrow's economy.